Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, last week we looked at the financial performance or the performance of stock markets at the mid-year of 2019, and they were quite impressive results, as you may recall. Today we're taking a look at the more conservative fixed income or bond market segment of financial markets. And locally and internationally, there were some differences in performance, but overall stable to positive in terms of returns. So what can investors expect in the second half of 2019? Well, let's take a look. And locally, we're talking about stability. There was not much change to the return that bond investors or purchasing government bonds might expect between the start of the year and the middle period of this year. Year-to-date, changes were very minimal in terms of the Trinidad and Tobago government bond yield curve. As you can see, the May 2019 yield curve in orange is pretty much lying almost exactly on top of that January 2019 in dashed green line as well. So not too many significant changes there in terms of returns. And what has been driving some of these, well, lack of changes? Well, there's really been a limited supply of new bonds to the market for public investors, some private placements, but for the public, generally not too much to talk about. Other factors would have been that excess reserves would have changed or actually increased from January to May by just around $500 million, from 3.5 to just under $4 billion TT. Inflation has remained quite subdued. In fact, the rate of inflation has decreased from 1.4% in January 2019 to just around 1.2% as at the latest figure of May. So that rate of increase of prices based on official central bank data has actually decreased by 0.2%. And the central bank's monetary policy tool, which is the repo rate, which is a tool used for signaling where interest rates should be going or the direction of interest rates, has actually remained stable from January 2019 to June of 2019. No changes there, it's staying stable at 5%. So what can investors look forward to in the local market, in the local bond market that is? Well, other than the May 2019 announcement of a coming housing bond of size of $1 billion and 4.5% for 5 years, there's nothing too much in the pipeline that investors would be looking forward to, barring some surprises. Now, switching gears to the international markets, well, certainly a change or much more activity than in the local market. In terms of US Treasury curve, the US Treasury curve or government bond yields, we can see that June 2018 curve in blue was nice and upward sloping as of June 2018, with 6-month yields at 2.11% and a 10-year yield at just around 2.86%. Now, fast forward to June 2019, and that has totally changed and actually inverted, whereas you can now actually earn a higher yield on government bonds at around 2.1% for a 6-month US Treasury bill investment, as opposed to just around 2% or just over 2%, 2.01% for a 10-year. So that's an inversion of yields, meaning that it's actually more rewarding for government bond investors, US government bond investors, to invest on the short end of the yield curve as opposed to the long end. And why would this have occurred? Well, there was pretty much an about turn in terms of interest rate policy and decision making, whereas in 2019 we initially expected or forecast 2 to 3 interest rate hikes. There's now the talk of interest rate cuts in 2019. In fact, market investors or market participants are pricing in a 100% probability of a rate cut at the next central bank or US Federal Reserve meeting rather in July of 2019. So that's this month. Now, what has that meant for investment returns in the bond markets? Well, to the far right, it's actually been one of the best years or first half performances thus far in recent memory, with investment grade bond return, total returns up 9%, that's in the orange, and high yield investment returns up just about 10% at the mid-year mark of 2019. So certainly very encouraging results for bond investors thus far, driven primarily by that change in interest rate policy. Now, with a more local flavor, Moody's credit rating agency would have recently maintained its less than investment grade or speculative grade rating of Ba1 for Trinidad and Tobago, but that does not have seemed to have affected investors' expectations too much. In fact, since the start of the year, bond yields on Trinidad and Tobago US dollar international bonds have actually been declining. So, for example, the Trinidad and Tobago 2026 bond in that blue line would have decreased from a yield of about 5.68% all the way down to just around 4.5% as at the end of June. And the Trinidad and Tobago 2024 bond would have decreased from a yield of 4.83% to just about 3.84% over that comparable 6-month period. So a change of about a 1% decrease in bond yields for Trinidad and Tobago bonds, certainly signaling that investors seem to be more confident about Trinidad and Tobago's prospects, or it could be rather just a case of rising tide floats all boats, and bond prices for Trinidad and Tobago bonds would have also appreciated in similar fashion to the rest of international markets. Just by the way, Moody's would have indicated that they maintain their stable rating because of that $6 billion cash war chest that is the Heritage and Stabilization Fund, and expected turnaround in the energy sector, among other factors. So what can international bond investors look forward to in the second half of the year? Well, indeed, the yields have come down quite significantly. At the start of the year, in January of 2019, investment-grade bond yields for investors would have ranged between 4 to 6%. As at current levels, that's now come down again just about 1% to that 3 to 5% range. And for high-yield investors who are slightly riskier, that yield would have come down from just around 6 to 8% to a range of more in the vicinity of 4 to 7%. So a much more challenging environment to find that nice juicy yield or return from fixed income investments. But certainly the market seemed to be responding quite positively to that change in interest rate direction by the US Federal Reserve. That's it for this week's Bourse Report. For more information, give us a call at 226-8773. Email us at invest@boursefinancial.com or check out our website at bourseinvestment.com. Have yourselves a wonderful investing week. This has been the Bourse Report.